And close the door. Okay. Okay, hi everyone, welcome to today's webinar. So for today's session, we are going to be talking about the ICT trading strategy, and this is going to be the second part of the series. We are going to give about 1 to 2 more minutes to let more people join the session because I can still see some people coming in. So yeah, we'll begin in about 1 more minute. And in the meantime, let me know if you guys can see me and hear me. And yeah, I'll see you guys in 1 more minute. Thanks, everyone. Okay, let's go ahead and get started. So as per usual, a risk warning and disclaimer. All products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, we have some viewing from Philippines. Hi, good afternoon, and Nigeria as well. So, very good morning to you. Okay, let's go ahead and get. Okay, so I'm Melanie. I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to look at how to apply the ICT strategy, the action plan, liquidity pool manipulation, stop hunts, and market structure. So we'll look at how to overcome all of that and how exactly we can use ICT trading. Okay, so let's briefly do a quick recap for those of you guys who weren't here with us in our the first session. So let's define what exactly we mean by inner circle trading. So it's a trading methodology that focuses on understanding the inner workings of the financial markets. So it's actually now going to become one of the most popular trading strategies since it focuses solely on price action. Originally created by Michael Huddleston, it was made to trade the Forex market, but traders are using the same strategies to make profit in all and any market that they trade. So it involves analyzing market dynamics, identifying supply and demand zones, and we'll look at what exactly we mean by those in a little bit, and utilizing price action analysis to make informed trading decisions. So why is this important? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give us a significant edge as traders. So since ICT, as we mentioned, focuses a lot on looking at the price action, so it focuses on technical analysis, operates under the premise that by studying the price movements, support and resistance levels, which are also known as your supply and demand zones, and order blocks, one can to some extent pinpoint the areas with the highest liquidity concentration, and consequently forecast emerging trends. So I'll talk a bit about what we mean by liquidity concentration in a bit. Um, but yeah, so by mastering these ICT techniques, it's kind of a way to enhance our ability to identify high probability trading opportunities and also manage your risk all at once. So let's go through a quick recap on the key concepts of ICT trading. Um, okay, so firstly, we have liquidity, displacement, market structure shift, inducement, fair value gap, optimal trade entry, and balanced price range and order blocks. Okay, starting off with liquidity. So there are two types of liquidity, the buy side and the sell side. Okay, please ignore the second line. So buy side liquidity basically represents the level on the chart where short sellers will have their stops positioned. Sell side liquidity will obviously just be the opposite of that. So it represents a level on the chart where long buyers, traders will place their stops. In both cases, these levels are often found at or near extremes, at the tops or bottoms of the ranges, and are often viewed as areas where traders are proven wrong and therefore will want to get out of their trades. So this is an example. So you can see another way of saying it if you've been here through our webinars for a while, it would just be the swing highs and the swing lows of your chart. Very simply put. But basically, the understanding behind this is that the nature of this concept is that it'll commonly accumulate or distribute positions near levels where many stops reside, which would be at the swing highs and swing lows. So the sheer amount of stops at key levels allow a larger player to fully realize their position. Once that level at which many stops are placed has been traded through, it's often that price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. So since, of course, as individual traders, we might not have as much capital as the larger players, such as your banks, and government agencies, obviously you would just want to follow these areas where they're most likely to place their stops, and then expect price to reverse course, head in the opposite direction, and follow these liquidity areas. Next key concept that we're going to look at is displacement. So displacement in short is a very powerful move in price action, resulting in strong selling or buying pressure. So generally speaking, displacement will appear as a single or group of candles that are all positioned in the same direction. So you can see that here. We have a strong selling pressure, so we have a downward movement for the candlesticks. Strong selling pressure here as well. We see the three candlesticks moving in the same direction. Strong buying pressure as well. We see that same upward trend. So this can also be really closely linked to your candlestick shapes. If you guys were here for, I think, one of our recent webinars where we went through the different shapes of your candlesticks, those are really good to use as well in addition to identifying displacement areas. Okay, so these candles typically have large real bodies and very short wicks, as we see here. And it suggests that there's very little disagreement between buyers and sellers. So often a displacement will occur just after a liquidity level. So as you mentioned earlier, liquidity level is basically at your swing highs or swing lows. Once that level has been breached, once price has reversed off of those levels, then it will often result in the creation of both a fair value gap and a market structure shift. So we'll get into those concepts in a little bit. Any questions so far about displacement and liquidity? Okay, if not, let's move on. So next, let's look at market structure shift. So an uptrend is basically when price is making higher highs and higher lows, and a downtrend would simply be when price is making lower highs and lower lows. So in short, you can see how we identify the market structure. So the swing highs and your swing lows just have to be pretty significant. So this plays into any kind of analysis, not just for ICT trading strategy, but also if you're just using your Fibonacci, for example. You would want to look for a chart that has a very clear market structure with clear swing highs and swing lows. So that's easier for you to draw your Fibonacci levels, do your analysis on your support and resistance levels, um, finding your trends, and so on and so forth. So here's an example of a pretty clear market structure. Okay, you can see price generally moving in a downtrend. And here, another way you can identify your market structure or the trend is by drawing your trend lines. So what makes a valid trend line is basically if there are at least 3 touches on your trend line. If it's a downtrend, like we see here, we would be expecting your touches to be below or on the underside of your line, like we see here. Okay, so you can see it's drawn underneath it. And if it's moving in an uptrend, we would draw it below on the underside of the price structure. Okay, so this is an example of the market structure shift since price is or it has been moving in a descending trend line as we see from these 3 arrows. But once we start to see price breaking out of your descending trend line, or any kind of um momentum indicators, and we'll go through some examples of momentum indicators that you can use in a little bit. But for this example, we can see price poking out of the descending trend line. So it's breaking out of this downtrend, right? So it suggests a shift in market structure, suggests that price might see an uptrend start to form. Okay. And so this is an example of a market structure shift. Okay, next, let's look at inducement and fair value gaps. So starting off with inducement, price rarely moves in a straight line. So within a larger trend, there are almost always counter trend moves, and these counter trend moves are the result of lower time frame liquidity hunting. Okay, I'll get into fair value gap in a bit, but here's the example of an inducement. So it's basically as you can see from the chart, it basically occurs when price bounces or gets rejected, and then it targets a previous short-term high or low before continuing in the same direction as the longer-term trend. So the longer-term trend in this example is pretty bearish. You can see price moving in a downtrend, and you see the shorter-term price movements or inducement areas is basically when price moves above this resistance level, this very slight resistance level from that small swing high. If we look at the subsequent price movement as well, price breaks above a smaller swing high, and those areas that we've circled are basically the areas of inducement. Okay, any questions so far about market structure and inducement? Okay, all good. Okay, looks like everything is okay. Okay. So we're gonna get into the part that's a little bit more complicated. Okay, let's talk about fair value gaps. So going back to our previous slide, so fair value gaps are basically created within that displacement that we talked about earlier. Okay, and are defined as, yeah, not yet. Okay, cool. What was I talking about? Oh, yes. So fair value gaps are created within the displacement that we talked about earlier and are defined as instances in which there are inefficiencies or imbalances in the market. So these imbalances are visualized on the chart by a three-candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not match. So again, this kind of plays into that candlestick shape. Um, Let me see if I can find an example for you guys. But I think we have some examples here in this chart. Okay, so let's look at the fair value gaps that have been filled first. Okay, so um, so it basically refers to the gap that occurs when market moves so quickly in one direction that there's an imbalance. So this normally happens when price is moving in a trend, so a downtrend or an uptrend. In this chart that we're looking at, we're seeing price move in a it's kind of ranging, but we see general downtrend. How do we know it's a downtrend? Because price is making lower lows, and lower highs as well. Okay. So this is typically looked at on the lower time frames. So this could be like 15-minute, maybe 30-minute time frame, or even 1 hour to 4 hours. It normally won't go below 15 minutes because then the chart gets a little bit more difficult to analyze. Okay, so if we look at the fair value gaps that are unfilled, okay, um, so the FVG or fair value gap here is basically visible, okay, the areas that we've highlighted, and the areas where the candles don't overlap with each other. Okay, so it's basically these areas where we don't see any candlesticks overlapping. So that's pretty straightforward. The significance of these gap areas is that the idea is that the market might revisit these gaps to fill them in. So that means that price could return to these levels to balance out the previous supply and demand of those levels. Okay, so that means traders often will try to find potential entry points to join the trend or catch that reversal towards these areas. These fair value gaps have been filled, and you can see that there's an overlapping candlestick with that previous candlestick. So here you can see that candlestick overlaps with the previous one, here as well overlaps, and lastly here it overlaps as well. So the trading strategy that you could use over here, for example, would be waiting for price to fill these gaps, these unfilled gaps. So after identifying these gaps, you'll wait for price to return to that area. If price begins to retrace into these gaps, then you can look for confirmation signals. So it could be like candlestick patterns, or you could use other indicators like your momentum indicators to enter the trade. Okay? Yeah, I hope that I explained that pretty um clearly. Okay, let's move on. So the next key concept here is optimal trade entry, and we'll talk about Fibonacci in a bit. So if you're just unfamiliar with it, we will go through it in a bit. But basically, according to the ICT trading strategy, the best place to get into a trade can be identified by utilizing the Fibonacci between the 61.8 and 78.6 level. Okay, that's pretty straightforward. So next, balanced price range and imbalance. This is pretty closely linked to your fair value gaps since it's a result of that imbalance. Okay, so it's a result of an aggressive move up that's immediately followed by an aggressive move down, or vice versa. So an aggressive move down that's immediately followed by an aggressive move up. What's left of either of these instances is essentially a double fair value gap, which we talked about earlier. So these act as a magnet to the price before continuation move higher or lower. Balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from these areas. So most of these, this last concept we've already covered in our previous slides on market structure shift and also fair value gap. Okay, so now let's talk a bit about Fibonacci retracement since we mentioned the 61.8 and 78.6. So if any of you guys aren't too familiar with Fibonacci, we will do a very brief intro to it. So here's kind of a checklist to follow if you're just starting out. Firstly, we want to look for clear market structure. So we're looking for any clear big zigzags or any swing highs or swing lows. And we've shown you examples previously already. Next, we want to identify the recent trend. So is price moving in an uptrend or a downtrend? Okay, and it's important to always follow the general trend. So if price is moving in an uptrend, we would go in for a buy. If it's going in a downtrend, we're going for a sell. Unless, of course, you have analyzed it and you have very compelling reasons that you think price is going to reverse or bounce off a specific level. Yeah. Otherwise, we'll follow the trend. Number 3 is to identify recent major swing lows and recent major swing highs. And lastly is to connect the two extreme points, like you see here, starting from the highest to lowest in a downtrend and the lowest to highest in an uptrend. Okay, so there are a couple of different ways that we use the Fibonacci retracement tool, but I'm not going to get too in-depth into it for this webinar session. I'm just going to focus mainly on the Fibonacci retracement technique, which focuses on the mid-range levels. So that's namely from 0% to the 100% over here. Okay, so the levels that we look at normally would be 23.6, 30.2, 50, 61.8, and 78.6. Okay, and for ICT, they recommend you to go in between these two levels here as your entry. So some examples of how you can use a retracement. Price, you can see, rebounds off of the highlighted area at 61.8 level. Okay, so that's basically how you use Fibonacci. You can see we are following the price, the shape of the price structure pretty closely. Starting point here, ending point here. See price rebounding off at the 61.8% level. Okay, so what does smart money look like in price action? So there are a couple of terms that they use that's pretty similar in concept, like conceptually, to what we already have been going through in all of our previous webinars. So for example, if we're normally like when I analyze or when I do my live analysis sessions, I will call certain areas support and resistance. They would call it supply and demand areas or your order blocks. Okay, so that's just simply a replacement or a different term for supply or demand and that an asset experiences. Breaker block or mitigation blocks. So this is what is traditionally called your support and resistance levels as well. It's just all following the order block term. And then flip zones are basically the levels where you can expect price to reverse off of. Fair value gaps, we've already talked about them, based on the imbalances on the market when demand outpaces supply or vice versa. And liquidity gaps, grabs rather. So let's talk a bit about liquidity pool manipulation. So liquidity pools basically refer to areas on a chart where significant clusters of buy or sell orders are located. Excuse me. Excuse me. So these liquidity pools act as magnets for your price. And they represent zones of substantial market interest. So by identifying liquidity pools and understanding their significance, traders can anticipate potential price movements and position themselves accordingly. So we already talked about liquidity in the first few slides, but this is just kind of a recap for under smart money concept. Okay, so let's talk a bit about how you can manage your trades while using your ICT. Okay, so just very quickly, why is it important to have trade management strategies? Firstly, is to control risk. So trade management strategies, such as your stop loss orders and position sizing, can help traders to limit their potential losses and manage overall risk exposure. Maximize profits. Of course, it enables you to lock in your profits and maximize returns using take profit orders and trading stops. And trading stops is going to be something that we're going to talk about in a bit, where we're going to talk about how you can use certain indicators or momentum indicators to confirm your trade after you've used ICT to analyze as a technical form of technical analysis, then you can use your indicators to confirm that analysis. Number three, manage emotions. So, of course, even in volatile markets, these can prevent impulsive decisions as driven by fear or greed. So, having a specific structure and trade management techniques and rules that you stick to can help you to stay calm and rational. Improve trade efficiency. So by having a well-defined trade management plan, traders can make faster, more informed trading decisions and avoid the cost and time having to constantly monitor and adjust their positions. And lastly is increasing consistency. So when you follow a set of rules and you're consistent over time, you can reduce the impact of your individual losses and maximize the impact of your winning trades. Okay, so let's start off by going through the issue of having a fixed take profit or stop loss. Okay, so let's take a look at this example. The red area shows a strong resistance area since there have been two swing highs that are in line with that area. So if our trading strategy requires us to have a fixed take profit of 100 pips, we will place the target beyond that strong resistance area. Okay, so let's see how this plays out. So price shot up. It missed our target profit by a few pips before reversing back down. Okay, reason for this is that price tends to reverse off of really big areas of resistance and support. Now, in an alternative scenario, if we had placed our take profit before the key resistance area, we would have gotten a profitable trade. So it's important to look at the charts and adjust your take profit and stop loss accordingly instead of just blindly following a fixed target profit of 100 pips, for example, just because some forum tells you to do so. Okay. Okay. So what is the proper stop loss take profit placement? So this is just a guide, but we normally will recommend you to place your stop loss beyond and your take profit before. So what does that mean? It basically means, okay, here we're talking about Fib confluence. Basically, Fibonacci confluence occurs when you have two or more Fibonacci levels that line up, which basically suggests that price will be attracted to these areas. So, but this also works for strong resistance areas or areas where you are predicting areas of strong supply and demand. Yeah, you get the idea. So it works for any kind of um big areas that you're looking at, not just Fibonacci confluence areas. So we would place our stop loss beyond these areas because price is more often than not attracted to such areas of confluence or resistance or support, supply or demand, whatever you call it. And if your stop loss is placed right before instead of beyond it, you'll most likely get stopped out right before the market starts to reverse. Okay, so that's one of the reasons why people start to complain about stop hunting as well. And if you are talking about take profit, we'll place it before any big resistance or area. And reason being is that when price reaches these areas, there's a high chance it won't be able to go beyond it. So instead of reaching your profit target, it reverses back to your entry or even worse, your stop loss. And that's one of the reasons why people complain that the market is being manipulated because they might miss their take profit by 1 or 2 pips. Okay, so the example that I have here, you can see if we're going in for a buy entry, for example, we'll place our take profit below the confluence area and your stop loss would be below as well. Now, if we're looking at a sell entry, for example, you would place your take profit above, stop loss above that major resistance area. Okay? Okay, so let's now talk about the problem with a fixed stop loss. So in this example, you can see we have a nice support level with 2 swing lows. So this, if we're looking at the ICT trading strategy, we would label this as one of your liquidity areas. So you can see it's pretty much the same concept, just with a different names. So you have a nice support level here. We're expecting price, which is here, to continue all the way up to this swing high. So our strategy has a fixed stop loss of 100 pips, which is right above this support level. Okay, so instead of going up, price goes down instead, touches the stop loss and bounces perfectly from the support. So what we should have done instead was to place our stop loss slightly beyond the key level of support or resistance, so that we don't get stopped out, and so that we're giving price more room to bounce off of that level and hit towards our take profit. Okay, so what should we do instead? So that's why it's important to have a dynamic stop loss and take profit placement. Okay, so we'll go through a couple of examples of dynamic stop loss placements, different techniques that you can use for risk management. Okay, so why is it important? It's used to manage risk. The level of the stop is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of the dynamic stop loss is to lock in profits while minimizing potential losses. And lastly, the placement of the stop loss can be determined by various technical analysis indicators or market conditions, such as volatility or market trend. Okay, so here's our first example. So this demonstrates your dynamic stop loss. So price here has bounced off nicely off of that support level at 86.721. And we're expecting it to reverse off the entry at 87.8 in line with the 100% Fibonacci projection level. Okay, so here you can see we have another couple of Fibonacci levels that line up. So, and it lines up with this swing high as well. Okay, yeah, so we're placing our stop loss below it or before that level. And price is currently testing that 87.819 level at the entry. Okay, so instead, stop loss should be placed beyond it. Okay, to ensure that when price hits upwards, there's room for it to reverse and hit towards our take profit, like we see over here. Okay, another example. So here we're expecting price to bounce off of our entry at 87.625 and the pullback resistance that's in line with 78.6% Fibonacci retracement. So in line with our ICT strategy where we should enter our trade at the 78.6%, either 61 or 78.6. Here our entry is 78.6. Stop loss is placed at the swing high resistance and take profit is placed at our swing low support. Okay, so price hits our entry and has nicely reversed off of it and is heading towards our take profit. Okay, price touches our take profit before reversing off of it. So that's why if we had placed our take profit any lower, we would have missed this by a few pips and we would have gotten stopped out. Okay. So now that we've talked about dynamic take profit and dynamic stop loss placement, let's talk a bit about the different kinds of um, momentum indicators that you can use, okay, for your stop loss. So let's talk about trailing stop loss. So it's a type of stop loss order that is set at a certain percentage or dollar amount away from the market price. The idea behind a trading stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. So I have an example there for you to read, but it's basically useful since it allows traders to manage risk and lock in profits dynamically as the market moves. Okay, let's look at the different indicators that you can use now. So first, we use the moving average indicator. We use parabolic star, chandelier, ATR, support and resistance levels, and also a combination of all of these levels, all of these methods. Okay, so let's talk about the first method or the first example where we are using moving average. So here you can see price kind of moving in this ascending trend line, right? We have three touches. Price is making higher highs and higher lows. So we're expecting price to continue in this ascending trend line. But when you see price break out of that trend line, that's a indicator that price might continue moving in a bearish or in a downtrend. So we're going in for a sell entry, especially since when price moves above our moving average, it's a bullish signal. Once price moves below it, it is a bearish signal. Okay, so you can see price breaks under our moving average. And once price breaks above it, our trading stop loss is triggered and we get out of the trade. Okay, so you can see it's a good thing that it got us out because we would have lost all of our profits from here, from our entry until this point, if we didn't get out of the trade before this happened. Okay, this session is being recorded, so I'm pretty sure if you email IronFX admin, they should be able to help you out. I'm not too sure where this recording will be posted, if it's on YouTube, but you can just email I'm pretty sure the email is on the IronFX website. So just email them and I think they will be able to help you out. Okay, so next, moving on to the next indicator that you can use is trend line. So as we mentioned earlier, this is the same chart. Price is breaking out of our ascending trend line rather, and it's also moving in this descending trend line. So it's moving below. Once price breaks out of that descending trend line, we get out of the trade. Similar concept with a parabolic star. When price is moving above your indicator, it's a bullish signal. When price moves below it, it is a bearish signal. So price is moving below it, and once it moves above your parabolic star, then you can get out of the trade. It automatically gets you out of the trade. And lastly, chandelier and ATR on that same example, price is moving below, so it's a bearish signal. Once it moves above, your ATR and chandelier stop loss are both triggered and you get out of the trade. Okay. Yep. So here's another example where we are combining support and resistance with your moving average. So one way that we normally analyze is by a combination of methods so that you kind of confirm your analysis as much as possible. So here we see price breaking out of our descending trend line. Okay, price is also moving below our moving average, so it's a very bearish signal. So we're going in for a sell entry over here. Price continues to move below your moving average, and you were right, so you get your take profit here. And once price moves above your moving average, you're stopped out anyway. But you had already gotten that take profit. Okay. Another example, price moving below this ascending trend line. So it is a bearish signal going in for a sell towards our take profit here. So how can we use breakouts as a trading stop loss? We did go through a couple of these examples already. But basically some steps to take note of. Breakouts are usually high volatility events. Price can spike up and reverse almost as quickly, so a stop loss will help you to manage your risk and protect your capital. Trading stop loss can help you to protect your profit, as we've seen in our previous examples as well. Okay, are there any questions so far? I do have a couple of examples on a combination of how you can. So for example, here we are using parabolic saw, support and resistance, as well as moving average, to kind of estimate where our price is headed towards. So here you see price moving in a downtrend. Once it bounces off this support level, it moves above both of the indicators. So you can go in for a buy, towards any kind of take profit level that you want. In this example as well, we're using, again, parabolic saw, moving average, and support and resistance levels. Your support and resistance levels in this example, we're basically looking at overlap levels. So overlap levels are basically levels where swing highs and swing lows line up. We're also looking at overlap and why did I forget the name? Pullback levels. So pullback level is, for example, like this one, where we have a swing high. Price breaks out of that swing high level and is now turning back to reverse back to that level. So that's how we decide where to place our support and resistance levels, basically. Yeah, so we use all of that in combination with the indicators that I've gone through already. And that's kind of it for today's webinar. Are there any questions? I didn't really go in depth with Fibonacci because we wanted to focus more on the ICT trading strategy and your risk management strategies that you can use for ICT, as well as any kind of trading technique that you wish to use. But if you were curious on Fibonacci and yeah, we do have a 4-part series where we go really in depth in Fibonacci and we go through many examples. So stay tuned for that. But if you want to do a bit of research on your own, you can take a look at theforexarmy.com. It's just this this guide here. Um, yeah, we have some videos, YouTube videos that you can watch too, extensions and retracements. Okay, my Wi-Fi is kind of bad, so it's not showing up here, but it should show up for you. Um, yeah, some things to take note of. Um, some levels. So we have the negative levels as well, which I didn't touch on today. Today, I only talked about the retracements. So basically the mid-range, all of these levels here. Yeah, so if you want to look a little bit more in depth into Fibonacci, feel free to take a look at this website. Yep, but or just stay tuned for our Fibonacci webinar. For record, if you want the recording, I think you can email IronFX. Um, yeah, I think if you email them, they will either send it to you or send you a link. How to use trailing stop loss. So basically, you could use any of the methods that we gone through earlier. So like any of these. And basically, when price moves above or it breaks out of the indicator, then your trading stop loss is triggered and you're getting out of that trade. Yeah. Yeah, I'm not too sure if they'll send you the link. So um I don't want to promise anything. Let me see if I can find the email. Mm, yeah, I think if you just filled this form in and told them that you want the recording to today's webinar, I think they'll be able to help you out. Yeah. Yep. That's all I have for you guys today. Thank you guys so much for joining me. If you guys liked me, feel free to follow me or connect on LinkedIn. It's just my name, Melanie Chong. And yeah, I'll see you guys again next week. And yeah, have a great rest of your week. Bye, everyone. Take care. Thanks, everyone. Thanks, everyone. See you guys. Bye.